Hi there. Review of reading 26 of the CFA curriculum, which deals with understanding balance sheets. So we'll take a quick look again at the balance sheet and the components, understand in detail the current assets and liabilities as well as the non-current assets and liabilities, study about owner's equity, goodwill, and the accounting treatment for the various classification of financial assets. So we've had an introduction to the balance sheet in previous reviews, but let's go through it again for the sake of understanding. So the balance sheet reports a firm's financial position at a particular point in time. So very important. Unlike the income statement and the cash flow statement that are periodic or are represented over a period of time, 1 quarter, 1 year, 6 monthly, etc., the balance sheet is as on a particular date. So as on 31st March or as on 31st December. It represents the cumulative result of the firm's operations since inception. So as on date, what are the assets that the firm has? What are the liabilities? And how much have owners invested in the business, that is owner's equity, is what the balance sheet gives a snapshot of. So let's recall the balance sheet equation. That is assets is equal to liabilities plus owner's equity. Let's revise again the three components. So assets are resources controlled by the firm today as a result of past transactions or past acquisitions that are expected to provide us future economic benefits or future cash. So assets are economic resources. Liabilities, similarly, are obligations that are expected now to require an outflow of economic resources, or for example, an outflow of cash in the future. So some example of assets would be cash, accounts receivables, plant and machinery, because of which we will produce goods and sell them in the future. Liabilities would be bonds or debt, accounts payable, etc. We'll study in detail these instruments in the slides to come. The difference between the assets and the liabilities is what belongs to the owners of the business is called the net assets or owner's equity. So this is the owner's residual interest in the assets after deducting the liabilities. Or assets minus the liabilities will give us the owner's equity. This is also called as simply equity, stockholders' equity, shareholders' equity, net worth, or owner's equity. So net worth, book value of equity, or simply book value all refer to owner's equity. Analysts also refer to the equity as net assets, that is assets minus liabilities. Or this is the amount that the firm directly owes to its shareholders, or it represents the shareholders' investment in the business. Now, current assets are those assets where the economic benefit or the cash is expected to accrue within 1 year or within the normal operating cycle of the company. The normal operating cycle is the time it normally takes to procure the inventory, sell the product, and collect the cash. So if within that time the benefit is expected to come from the asset, then the asset will be classified as a current asset. Usually the most liquid current assets like cash and marketable securities are presented first, and account receivables, inventories, etc. are presented later. So we'll study different categories of current assets in the coming slides. But just for example, receivables, inventory, cash are some examples of current assets that are expected to realize in less than a year. Current assets reveal information about operating activities. They generally are created and get extinguished as a part of regular operations of the company. Current liabilities, likewise, are those where the economic costs are expected to be realized within the normal operating cycle or within 1 year. A liability will also be called current if it's held primarily for trading purposes, like short-term debt or short-term instruments. And there should not be an unconditional right with the liability holder, that is with the company, to defer the settlement of the liability for more than 1 year. So if I can defer the settlement for, let's say, a time 2 years later into the future, then the liability will not be classified as current. So accounts payable, short-term notes payable, etc. are some examples of current liabilities. Non-current assets and liabilities, as the name suggests, will not be converted into cash or realized within 1 year or one operating cycle. Non-current assets, for example, plant and machinery, investments, as we will see in the coming slides, are items that accrue or give us information about the investing activities of the firm. So normally these assets get created when we've invested in a factory or in a new building or in some plant and machinery, etc. So these investments result into operations in the future. So because of a factory, I will have products that I can sell, or I will have a dividend income from my investment. So fixed assets or non-current assets result in operations in the future. Similarly, non-current liabilities normally give us information about the financing activities. So non-current liabilities like bonds payable or the long-term debt tell us that how much of our assets have been funded by longer-term assets and how much of the funding is through shorter or current liabilities. IFRS generally mandates that all firms report the balance sheet in the current non-current format, that is, current assets and liabilities be reported separately along with the non-current assets and liabilities. Exceptions are allowed for the banking industry and other sectors where a liquidity-based presentation is more apt, wherein the more liquid assets are represented first and the less liquid assets are represented later on in the balance sheet. Tangible assets, as the name suggests, are long-term assets with physical substance, that is, you can touch and feel them. The most common example is plant and machinery, equipment, natural resources. Please note that generally speaking, all assets, current or long-term, are carried on the balance sheet at historical cost. Tangible assets, since they are long-term in nature, are also depreciated, and the net book value will be recorded as the historical cost minus the accumulated depreciation. We'll study depreciation and this concept more in detail when we study long-lived assets. Please remember that land is a tangible long-term asset that is not depreciated. The life of land is assumed to be infinite. Tangible assets that are not used in the core operations should be called as investment assets so that we can analyze them differently. So if I have some residential apartments that I bought from the cash of the company because I expected the value of these apartments would go up, or it was a good utilization of the cash, or I have certain other machinery that I don't really need to use in the business right now, then these assets will be classified as investment assets. Intangible assets, as the name suggests, do not have a physical shape or form. So these are long-term assets that lack a physical substance. Even financial securities are normally in demat form, that is, in electronic form, even though they also do not have a physical shape and form, but they will not be considered as intangible assets. They are classified along with the tangible assets. Identifiable intangible assets are those whose value can explicitly be derived based on the rights or the privileges that these assets convey to its owner. So a very common example is a patent. The patent on a drug, for example, gives me exclusive rights to market a drug for the next 10 years. Would this right have a value? Yes, I can price my product higher since it's a monopoly. I'm the only person eligible to sell. Similarly, copyrights, trademarks are assets which, when acquired, give me a certain value, and these are called identifiable intangible assets. Unidentifiable intangibles cannot be purchased separately and may have an infinite life. So a very common example is goodwill. We will study goodwill in later slides and also in the review of long-lived assets. Goodwill, trademarks, copyrights can also be internally produced, guys. So my own research and development or my own research team also produces these assets. But please remember that the accounting intangible assets can only be recorded when acquired. So internally generated assets, intangible assets, may not be recorded on the balance sheet. So if because my HR team is very valuable or my HR policies are so good that people like working for my company, definitely this fact has value, but it cannot be recorded on the balance sheet. The good HR policies will not be an intangible asset in the accounting statements. They very well may be an economic asset. Another important concept is that of the historical cost and fair value. So historical cost is the value that was exchanged at the time of acquisition or the cost price of the asset. So this includes the original cost as well as all expenditure that needs to be made to get the asset ready for use. So freight, labor, installation, anything that needs to be spent for the asset to be in use would be a part of the historical cost. Remember guys, that most balance sheet items, that is assets as well as liabilities, are carried at historical cost. So you should be aware that historical cost is an objective measure. It is relatively easy to measure. There will not be a lot of ambiguity on the cost of acquisition, and this is what the asset is normally carried at. Fair value is different from the historical cost. This is the fair market price that somebody would be willing to pay for the asset or the liability today. So it is the amount at which an asset can be bought or sold, or a liability can be incurred or settled between knowledgeable, willing parties in an arm's length transaction. That is, a fair exchange today would happen at this price, that is the market price, not at the historical cost, even though the assets and liabilities are carried at historical cost. Fair value is a subjective measure, and it can vary from one person to the other to a significant extent. Now, before we study each type of asset and liability individually, let's understand that broadly speaking, how do assets and liabilities arise on the balance sheet? So assets and liabilities come in because of the principle of accrual accounting that says that revenue must be recognized when the product is delivered, regardless of whether the cash has been received earlier or will be received later or hasn't been received yet. So if I have sold the pen or I have delivered the pen and that pen cost $100, then I have to book sales of $100 whether or not my client has paid me. Likewise, expenses must always match revenues. So if the pen was worth $50, then when I recognize a revenue of 100, I have to recognize a cost of $50. We studied this concept in the review on financial reporting mechanics. That was the second review on financial reporting. So please watch that video if you've forgotten the concept of accrual accounting. And I will show a profit of $50. So let's assume that in this case, our client hasn't yet paid us the $100 that he owes us. In that case, on the balance sheet, we'll report an item called accounts receivable of $100, showing that this $100 of cash hasn't yet come. Likewise, if we haven't yet paid our supplier because we were waiting for this payment to come and then pay our supplier the $50, there would be another entry on the liability side as well called accounts payable of $50, representing that this $50 of cash expense that I've shown on my income statement hasn't yet been paid. So assets and liabilities arise because of a mismatch between the income statement recognition and the cash flows, like we just explained. So current assets are those that will be realized in the short term, 1 year or one operating cycle. First and the most liquid current asset is cash and cash equivalents. So cash is in our bank accounts. Equivalents are short-term debt instruments, normally with a maturity less than 90 days. So that cash is also going to come in very soon. This cash can be used or deployed in the business in acquiring other assets. Marketable securities, likewise, are investments that can be liquidated very easily. So if I'm holding some shares of a listed company, or if I'm invested in government securities, then these will be called marketable securities. They're also assets. They can be converted into cash when I sell them, and then that cash can be deployed as I require in the business. Accounts receivables, as we studied, also called as trade receivables, are outstanding dues from our customers. These are also called debtors. So if I have made the sale, delivered the product, and recognized the revenue, and I'm still yet to receive the cash, then that outstanding cash would be sitting as an accounts receivable. So let's say I received $50, but $50 is yet to come. This asset account sometimes also has a contra asset entry called provisions for bad debt. The provision for bad debt, let's say in this example, was $10. Then what we are saying is that this $50 of receivable is not likely to all come through. I don't think the client will pay more than $40. So to reflect my analysis or my expectations from this account, I'm writing off $10 as a loss in the income statement and putting a bad debt provision on the balance sheet as -10. So this is a contra asset, that is, it reduces the value of an asset. Otherwise, I'm expecting $50. Now, if that expectation changes, I think he will pay me only $40. That means $10 have to be written off as bad debts. That bad debt provision will come below the accounts receivable as -$10. Inventories consist of raw materials, work in progress or semi-finished goods, and finished goods that I have not yet been able to sell. This inventory is also a current asset. It will be completed into a finished good, or if it is a finished good, it will be sold sometime soon and the cash will come, or the economic benefit will come. There can be certain other current assets also, for example, a prepaid expense. So I've already paid for the repair of my factory a cash of $100. However, the factory hasn't yet been repaired. As on the balance sheet date, today when I'm making the balance sheet, the money has already been given out, but nobody has come to repair my factory. So the cash will be lower to the extent of $100 because it's already been paid. And corresponding to this outgo, there will be an asset called prepaid expense. Is this instrument or is this money paid an asset at the moment? Yes, because in lieu of that money paid, the service provider has to come and repair my factory. There will be a prepaid expense of $100. As he repairs my factory, this asset will go away and I will show the expense on the income statement for the repair of my factory. Non-current assets are those whose value will be realized over the long term, a period greater than a year. The most common non-current asset is property, plant, and equipment. This is my factory, machinery, the building and equipment, which is generating my product and which is generating sales in the future, probably for 10, 20, 30 years. So remember, non-current assets normally represent investments that generate operations in the long run. So because of this, property, plant, and equipment, I get operations in the future. The property, plant, and equipment, as we studied, is normally carried at historical cost minus accumulated depreciation. So please understand that the cost of acquiring this property, plant, and equipment, let's say $100, is spent right on the date that I'm acquiring it. Let's assume at t equal to 0. However, the entire expense is not shown in the first year. Because this plant is going to be used over many years, I take a relatively smaller hit, which accounts for the usage of the plant in that year as the expense. So $10, $10, $10, according to the matching principle, I apply to each of the years. So at the beginning, the value of the plant is $100 in my books. As I'm using up the plant, the net asset value on my books will be equal to the historical cost minus this cumulative depreciation that I have done up till now. So at t equal to 3, it'll be 100 minus 20, that is $80. We'll study the concept of depreciation and property, plant and equipment in more detail in the review on long-lived assets. Investment normally refers to investments in physical assets which are not a part of my core business. So for example, I have a residential building which I bought because I thought the value will appreciate, or I have some other plant and machinery that I'm holding on to but is not being used as a part of my core operations at the moment. So those assets will be called as investments that are expected to generate value in the longer run, but not in the next 1 year, or they will not be liquidated in one operating cycle or in 1 year. Intangible assets are long-term assets that don't have a physical shape and form. Identifiable assets are like franchise agreements, patents, other privileges and rights whose value can directly be calculated from the agreement or from the description of that agreement or that right. Non-identifiable assets have an infinite life and you cannot exactly pinpoint where the value is coming from. A good example of a non-identifiable asset is goodwill. We'll study these assets in more detail again in the review on long-lived assets, but understand that just like property, plant and equipment is depreciated, identifiable intangible assets are amortized and are kept on the books at historical cost minus the amortization. Concept is very similar to the depreciation of tangible assets. So just like we owned marketable securities, which was like a small stake in one business that we could sell out at any point in time, financial assets represent bigger stakes that the company plans to keep or that are expected to generate value in the long run. If I own 10% or 50% of another company's equity, then that investment will be carried on my books as a financial asset that is expected to generate dividend income or value in the long run. Similarly, investment in another company's debt, which is going to come back to me over a longer period in time, will also be a financial asset. Deferred tax assets and pension assets we will study in detail in a later review. Pension assets more at level 2. Deferred tax assets are covered in great detail in level 1 in a separate reading session altogether. Current liabilities are those that will become due or the economic outflow will happen over the short term in a period less than a year or an operating cycle. A common current liability is accounts payable, which is the amount owed to suppliers for the goods or services that we have purchased but haven't yet paid. So we've purchased raw material worth $100, but we haven't yet paid it. So no cash has gone out, but there will be a liability that is an accounts payable or trade payable of $100. Notes payable are short-term debt obligations, normally with a maturity of less than 1 year. Could be taken from financial institutions or other companies which are expected to become due in less than one operating cycle and will cause a cash outflow. Similarly, the current portion of long-term debt, that is the amount of principal that has to be repaid this year, will also be a current liability or a short-term liability because this is going to be due this year itself. Notes payable and the current portion could be included in non-current liabilities if the maturity is greater than 1 year. Accrued liabilities represent expenses that have already been recognized in the income statement but are not yet contractually due. So if I sold a pen worth $100 and the cost of that pen is $50, so as soon as I make that sale and I make the income statement afterwards, I will have to recognize the expense of $50 because of the matching principal, showing a profit of $50. However, my agreement with my suppliers is that I will pay you at the end of the calendar year in which I sell my product. So I sold my product in the first quarter. So at the end of the first quarter, I'm showing a cost of $50. However, this $50 is not due until the end of the year, because that's my agreement with my suppliers, that I'll pay you at the end of the year in which I sell the asset. But at the end of the year, this payment will have to be made of $50. So at the moment, it will be called an accrued liability of $50, which will become due at the end of the year, and that's when I will pay it, because I've already sold the pen. Unearned revenue is also known as a customer advance. So I have promised to deliver a statue at the end of the year, and my customer has given me 100% advance payment of, let's say, $100. That is the cost of the statue. So the statue has to be delivered at the end of the year. As I'm making the balance sheet at the end of the first quarter, would my cash level be higher to the extent of $100, this cash that I've received as an advance payment? But against this cash, I have to perform the work, or I have to put in my time and effort in making that statue. So we will call this as a customer advance, or an unearned revenue of $100. As I deliver the statue, this $100 liability will get extinguished, and it'll come into my revenue as a $100 and will go into my equity as the profit that I earn on it. But at the moment, till the time I haven't delivered, it'll be a customer advance or an unearned revenue of $100. Taxes payable, as the name suggests, are taxes due to the government, which I haven't yet paid, and I will have to pay them in the current year or in the current operating cycle. So taxes payable are current liabilities. We now move on to a very important item called the working capital, which is calculated as the current assets minus the current liabilities, which has significant implications for analysis. So let's recall what are the different types of current assets: cash, marketable securities, inventories, accounts receivable, etc. And what were the different current liabilities? It was my short-term debt that I had to repay, or the payables to my suppliers, etc. Now, what would you make if this number was too low, or if this number was negative? That is, current assets were less and current liabilities were high. That would indicate short-term funding issues or short-term funding needs, because the cash and the current assets are not enough to meet the short-term obligations or the short-term debt and payables. So this indicates short-term funding issues or requirements. So we'll have to borrow to meet these short-term payments. If this number was too high, that means current assets were very high, current liabilities were less. Too high a number for the working capital implies that we are either sitting on too much cash or too much inventories, or our receivables are very high. That means our assets are not being properly utilized. It's not a healthy thing to be sitting on a lot of cash and not investing it. Like we'll study in financial analysis techniques, that no one ratio or no one tool can give the complete picture. So the working capital must be compared with the industry and especially the firm's competitors to decide whether it is at an acceptable level or is it too high or too low. But just remember, for analysis, not enough working capital may indicate liquidity problems, and too much of working capital may be an indication of inefficient use of assets. Non-current liabilities will become due over a longer period in time. And the most common non-current liability is long-term debt or bonds payable that will need to be paid as the repayments become due. We'll also study in a later review what capital lease obligations are and why they are represented as a non-current liability. Pension liabilities we will study in great depth at level 2, so just need to know the name, you don't have to understand a lot of detail about it. And we will study deferred tax liabilities together with deferred tax assets in the review on deferred taxes or income taxes. We now move on to understanding the components of owner's equity, also known as net assets or book value, computed as the value of the assets minus the liabilities. So the owner's equity consists of contributed capital. This is the paid-in capital as we studied in the introduction of financial reporting, plus the additional paid-in capital. Paid-in capital is simply the par value multiplied by the number of shares outstanding. The additional paid-in capital comes from the contributions made by new shares issued over and above the par value. So the contributed capital, that is the paid-in plus the additional paid-in capital, is the amount that has directly been contributed by shareholders into the business. The contributed capital also contains additional information about the par value of the shares. So this is also called the face value per share. Please note that this has no economic significance. A lot of times shares are issued with no face value or par value. They have no relationship whatsoever with the market price or the economic value or the market value of the shares. Authorized number of shares are the possible amount of outstanding shares. So these are the shares that the company has an enabling resolution for. That is, the shareholders have given an approval for the issuance of the authorized number of shares. Company may not have issued all of them, or that is, it can potentially have so many shares outstanding. Issued shares are the shares that have actually been issued to different investors and are assumed to be outstanding at the moment. Outstanding shares is the issued shares minus the treasury stock or minus the shares that have been bought back by the company. So contributed capital is the amount contributed directly by the shareholders. It is also known as common stock. So when we say common stock, we mean nothing but the contributed capital. This account also contains information about the number of shares outstanding. Preferred stock is somewhere in between common equity and debt. That is, it is guaranteed a fixed coupon, but it is junior to debt and senior to equity. That is, in the event of a bankruptcy, first the debt gets paid and then the preferred stock. Please note that the preferred stock that is shown as a part of equity is normally the non-cumulative preferred stock. Non-cumulative implies that if in one particular year the company misses the coupon payment because it did not generate enough cash flows or enough surplus, then the claim is forfeited. That is, next year the company is not liable to pay double the amount, or the coupon payment does not accumulate over the periods. If it's missed, it's missed. As against cumulative preferred stock, wherein if we miss the payment in one particular year, then it'll accrue and it'll have to be made in the later years. So cumulative preferred stock is more like debt, but non-cumulative is what we'd normally show as a part of owner's equity. Now we'll study minority interest in more detail in level 2. However, just to give you a brief definition of what this component means, it represents the percentage shareholding of the minority investors of a subsidiary. Let's understand an example. So if I'm the parent company, company A, having assets of, let's say, $100 and a cash on books of $50 and a total equity of $150, and I own 80% of a company B which has assets of $50 and an equity of $50, then the accounting guidelines mandate that I have to report my accounts on a fully consolidated basis, or the full consolidation method needs to be applied. That is, we will assume as though company B is 100% owned by company A, or the assets that we will depict on our balance sheet would be $150, cash of $50, equity of $190, and a minority interest of $10. This minority interest represents that entire asset is not ours. 20% belongs to the minority shareholders of B, or the minority shareholders of the subsidiary. Is there a guaranteed time at which I have to return this 20% or this $10? No. Is there any fixed obligatory payments or coupons that I have to pay to these minority investors? No. Hence, minority interest is a liability that is similar to equity. So it is a 20% shareholding of these minority investors of B, but the characteristics are similar to equity because there is no guaranteed time to maturity and there is no fixed payments that I have to make against this liability. Please don't worry too much about it if you didn't understand it very well. I do not expect this to be tested at level 1. You'll be taught this in great detail at level 2. So just know that there is one component like this that comes in the consolidated books of accounts. And just for reference, please remember that if you see minority interest on the balance sheet, then you know that these are consolidated accounts because minority interest only comes in consolidated accounts. Retained earnings on the balance sheet represent the cumulative earnings till date that have not been paid out as dividends. So these have been retained or reinvested by the company, and they represent owners' capital that has been put back into the business. So it's thought of like any other equity account. Please note that all the equity accounts that we are studying have the same economic significance or have the same economic claims. If the earnings made by the company have not been paid out as dividends, then we have to give additional return on those retained earnings because it is further investments by the shareholders into the business. Treasury stock is a contra liability account. That is, it reduces the value of the existing liability. So treasury stock is the shares that have been bought back by the company. So to the extent that we have paid to buy back these shares, the equity will reduce. So it will be a negative entry, reducing my equity. Let's assume I've bought back $100 worth of stock. So $100 will be knocked off from my equity. Accumulated other comprehensive income is the cumulative value till date of the 4 other comprehensive income accounts that we studied in the income statement. That is for adjustments for minimum pension liabilities, unrealized gains and losses on available for sale securities, similarly adjustments for cash flow hedges. And remember, these were gains and losses that didn't flow through the income statement but were directly adjusted in the balance sheet. Accumulated other comprehensive income is the cumulative sum of each of these items at the current date or the balance sheet date. So we've been hearing the term for quite some time now. Let's understand exactly what goodwill means and how it is calculated. The goodwill is defined as the excess of the purchase price over and above the fair value of the identifiable assets and liabilities acquired in a business acquisition. So goodwill is what you pay over and above fair value. Now, why would you do that? Why would you pay over and above fair value? So let's assume that you started a restaurant and the restaurant has started to do very well. Now you're short of capacity, so you want to expand the business, that is, add a little more seating capacity to your restaurant. So if you have a requirement like this, would you necessarily need to buy the adjacent store or the adjacent space? Because that's the only way you can expand your restaurant. Buying a space somewhere else or in a different place would not really serve the purpose because the demand is very high in this locality and you want to expand the size of this restaurant. Now the fair value of this adjacent space is actually just $100, but you are willing to pay $150 to buy this space because you know that you can extract a lot more value out of this space because of your restaurant, and you definitely need this space and only this space to be able to expand. So the fair value of this space is $100. That is, if any third party or anybody else would have bought this space, then looking at the location and the attributes, the fair price that anyone would have paid is $100. The owner is unwilling to sell, and to buy it out, you are having to pay $150 and you're willing to do so because of the synergies that you expect and the needs that you have. So this $50 that you're paying over and above the fair value will be accounted as the acquisition goodwill. That is the amount paid over and above the fair value. Please note that accounting goodwill differs from economic goodwill. Economic goodwill arises because of good business practices, good relationship with customers, good brand, good value in the market. So, as the company does business and it does so in the right manner, you generate goodwill amongst your customers, employees, and other stakeholders. Please note that that goodwill is not represented on the balance sheet. The goodwill that comes on the balance sheet is called accounting goodwill, and it can only come through a business acquisition. It is the price that you pay over and above the fair value in a business acquisition. Let's understand with an example. STEM Corporation paid $580 million for the outstanding stock of Leaf Corporation. At the acquisition date, Leaf reported the following condensed balance sheet. So you're acquiring Leaf and it has current assets of $100 million. Net property, plant and equipment, net means minus the accumulated depreciation of $640 million. A goodwill of $60 million. How would this goodwill have come? Please note, this is the goodwill that is already there on Leaf's balance sheet. So STEM is acquiring Leaf and this goodwill is already present. This goodwill must have been there when Leaf would have acquired some other asset at a price over and above the fair value. Liabilities are $350 and shareholders' equity or book value is $450. Now please note that these are the values of the assets and liabilities at historical cost, because the balance sheet otherwise is maintained at historical cost. The fair value of the plant and equipment was $100 million more than its book value. The fair values of all other identifiable assets and liabilities were equal to the recorded book values. So the plant and equipment, which is being carried at $640, if you had to buy it today or if you had to replace it today, then the fair value of this item would have been $740 million. And all other identifiable assets and liabilities were equal to their recorded book values. So the fair value of the current assets is $100 million. When you are valuing the company for an acquisition, you want to value its assets and liabilities. You want to buy this plant. You want to buy the cash. You don't want to buy that company because of its goodwill or for what it had overpaid when it did an acquisition. Remember, when STEM is buying Leaf, STEM will not value this goodwill. It will value the assets, it will value the plant at its fair value. But it will not pay anything for the goodwill that is there in the Leaf's books. The fair value of goodwill is 0. It is the value over and above fair value. Fair value of liabilities is $350. So can we compute the fair value of equity? It will be 100 plus 740 minus 350. That is 840 minus 350 or $490 million. So how much have we actually paid for buying this equity worth $490 million? We've paid $580 million. So what will be the accounting goodwill that will need to be reported on STEM's books? It will be 580 minus 490. That is a number of $90 million. So please note that STEM will report an investment or an asset of only $490 million because that is the fair value. And there will be an acquisition goodwill, like the entry here, of $90 million in STEM's books. Now, financial assets that are investments in debt or in the equity of other companies can have various classifications depending on the intention with which we purchase the assets. So remember, the assets are exactly the same. It is just the intent that decides the classification. So trading securities were acquired with the intention of making a quick profit and selling out. So they were not long-term investments. We are essentially speculating on the price. Available for sale securities were not purchased with the intention of selling them like trading securities or just for a small pop in the price. So they were bought for a more long-term use. However, they are classified as available for sale in the sense that if I have better opportunities or if I need the cash for some other purpose, I will not hesitate to sell these securities. So they are available for sale in case I require the funds. Held to maturity securities were explicitly bought with the intention of holding them until maturity, that is, receive all the coupons and the fair value at maturity. Now, once again, the assets are exactly the same. It is our intent that decides which classification is given to my debt or equity. Depending on the classification given, will decide the accounting treatment of these securities. So trading securities are always carried at the balance sheet at fair value. Whatever is realized, that is the dividend, interest, realized gain or losses, for all securities are always taken through the income statement. So if it's realized, it will go through the income statement. For trading securities, even unrealized gains and losses are taken through the income statement. Available for sale securities are also carried on the balance sheet at fair value. However, only the realized gains and losses are taken through the income statement. Unrealized gains and losses, please recall, were adjusted directly in the balance sheet under the head Other Comprehensive Income. Please remember that this was one of the 4 components of the Other Comprehensive Income, that is unrealized gains and losses on available for sale securities. So that's how the adjustment happens for them. They're carried on the balance sheet though at fair value. We'll understand with an example. Held to maturity securities are carried at amortized cost on the balance sheet. So it's just like plant and machinery is carried at historical cost less accumulated depreciation. Held to maturity securities are also carried at historical costs less the accumulated amortization or depreciation that we'll study in more detail when we study long-term liabilities. And that value is called the amortized cost. Just think of it as though it is being carried at historical cost only. And whatever is realized, again, will be taken through the income statement. Nothing unrealized goes through the income statement. Normally, held to maturity classification is applied to debt securities. So all interest and any realized gains or losses, if at all, will come through the income statement. So let's do an example and understand the concept. United Corporation purchased an 8% bond at par for $1 million at the beginning of the year. That means the price of the bond was the same as the face value of the bond. So it was purchased at par. Interest rates have recently increased and the market value of the bond has declined by $30,000. Determine the bond's effect on United's financial statements under each classification of securities. So if we assume that the bond was held for trading, that is, we just wanted to make a short-term gain and sell the bond, then on the balance sheet, the bond will be carried at the fair value, which will be 1 million minus 30,000, that is $970,000. On the income statement, whatever is realized would come. So what will be realized? It will be the 8% coupon, that is 8% into 1 million, or realized interest, or we can simply call it as interest of $80,000, and an unrealized loss. So the value has declined, but I haven't yet sold the bond. So it's still unrealized of $30,000, or total income statement impact of $50,000 on account of the bond. If the classification was available for sale, then again on the balance sheet, the bond would have been an asset, $970,000. However, on the income statement, only the realized gains and losses and the interest would have come. So the interest income of 80,000 would be shown again, but the unrealized loss would not come on the income statement. It would have directly have been adjusted under the equity account of other comprehensive income as an unrealized loss on available for sale securities as an amount of minus $30,000. So in both cases, equity is getting reduced by $30,000 in trading securities directly on the income statement. In available for sale securities directly on the balance sheet, no impact on the income statement. If the classification was held to maturity, then on the balance sheet the bond would have been at its amortized value. We'll prove in a later review that for a bond which is issued at par, the amortized value will always be the same as the original historical cost, that is $1 million. And on the income statement, only the realized component of the bond would have come, that is an interest payment of $80,000, or the coupon that the bond would have paid. So this is the accounting treatment under the three heads: trading, available for sale, and held to maturity. So just a small example depicting the changes in owner's equity. So the company began with an original contributed capital or common stock of $35,700, beginning retained earnings of $15,500 approximately, and accumulated other comprehensive income from past activities of minus $300, giving a total shareholders equity of $50,900 approximately. During the year, the company earned $4,867. There were unrealized losses on available for sale securities, on cash flow hedges, on pension liabilities, and foreign currency translation. So never mind the exact meaning of these four terms. You know the available for sale part now. However, you can ignore the other three, but note that they will affect my total equity in the other comprehensive income, or the accumulated other comprehensive income section. Company issued new stock worth $1,000, so that gets added, and it repurchased stock worth $5,500. So the common stock reduced to $31,200. The company paid dividends of $2,190. So the retained earnings grew from $15,499 plus 4,867 minus 2,190. And the accumulated other comprehensive income went up from minus 300 to minus 381 on the equity. So the total equity reduced from $50,900 to $48,900, primarily because of this big repurchase that the company has done. So that's about understanding the balance sheet. Please practice a lot of questions from the question bank, and we'll move on to understanding the cash flow statement next. Thanks a lot. See you next time.